You chased AI and crypto. Meanwhile, one ETF quietly returned 82.43% in the last year, and it wasn't hype-driven. It's tied to policy, not vibes. If NATO's 2% mandate keeps forcing budgets higher, why isn't this on your watch list? Today, I'll show you the Defense Tech ETF, sitting at about $3.47 billion AUM, launched in late 2023, new enough to be overlooked, big enough to matter, concentrated in 42 names like Palantir, AI-enabled Intel, RTX, Air Defense and Sensors, and Lockheed, Precision Aerospace. We'll unpack why analysts see defense spend growing roughly 5% annually to $3.6 trillion by 2030, and how a 62% top 10 concentration can amplify that policy-driven trend. Let's look where screens didn't. While the spotlight stayed on the same AI names everyone tracked, the invisible winner was built on something boring but powerful: government spending requirements. SHLD is a defense tech ETF launched in late 2023 with a one-year return of 82.43% and about $3.47 billion in assets. Big enough to matter, new enough to dodge most screens. It isn't a meme. It sits on mandated spend rather than sentiment. Most investors never saw it because their tools filtered it out. Many screeners default to popular, long-running funds and broad categories, which hide newer, specialized ETFs. Labels like industrials or aerospace bury defense tech hybrids, and default US-only views miss key transatlantic exposure. You didn't skip it on purpose, the filters did. Big gains usually trigger skepticism. Must be hype. Here, the engine is different. Defense is shifting toward practical tech that militaries actually deploy. Think AI-enabled command systems that fuse battlefield data so commanders make faster decisions. Autonomous drones that scout, jam, or strike without risking pilots. Hardened cyber that keeps networks and weapons systems online under attack. Robotics that handle logistics and dangerous tasks at scale. This isn't a trend cycle, it's modernization backed by law and budgets across the US and Europe. When everyone crowds into the same hot tickers, they miss what isn't flashing on their feeds. In 2023, capital chased semis and token plays inside the same benchmarks. That herd effect left less flashy, policy-tethered themes under-owned. While timelines recycled AI headlines, SHLD compounded because it wasn't competing inside that over-owned stack. You can see it in behavior more than in headlines. Money poured into broad tech wrappers, but defense tech didn't get the same narrative tailwind. Even so, the results flipped expectations. SHLD tracks procurement calendars, order backlogs, and multi-year programs. When governments greenlight a program, contractors take orders and start building regardless of weekly sentiment. There's a different risk profile. Instead of relying on momentum and quarterly mood, you ride policy and procurement cycles. Budgets turn into contracts. Contracts flow into backlog, and backlog creates revenue visibility. Screens tuned to past returns or broad tags don't measure treaty requirements, replenishment commitments, or multi-year modernization maps. They're not designed to flag a mandate or a procurement timeline. So the reveal is simple. SHLD's return profile leaned on a structural driver that standard filters miss. NATO and allied spending mandates written into how member states allocate resources. If you sorted for popularity, you missed it. If you mapped policy, it was obvious. The next step is testing durability. Are these budgets locked in, and for how long? In other words, what happens when growth is governed by contracts, not mood swings, and what does that mean for the cycle we're in right now? Here is where policy takes the driver's seat. inside a defense supercycle shaped by formal commitments, not market narratives. Global defense spend in 2024 hit about $2.7 trillion, up 9.4% year over year, the fastest pace since the Cold War. That jump reflects a structural shift, not a one-off spike, and it resets expectations for what durable growth looks like when budgets set the tempo. Skeptics call defense cyclical and point to post-conflict drawdowns. The counter is in the mandates that hardwire future spending. NATO's 2% of GDP target isn't a suggestion. It's a formal commitment that member states are now scrambling to meet. When legislatures pass requirements, ministries publish plans, and alliances codify targets, the discussion moves from if to when and how much. Funding then rolls across budget years with tranches tied to milestones, testing, and delivery windows, creating a pipeline that doesn't hinge on quarterly sentiment. That policy anchor translates directly into programs for modernization and replenishment, air defense, drones, cyber protection, and AI-enabled decision systems. Analysts project roughly 5% annual growth from here, pushing global spend toward $3.6 trillion by 2030. Framed against the recent 9.4% pace, that 5% path is conservative, implying sustained momentum rather than a peak and fade. Europe offers a clear case. Ammunition stocks and interceptor inventories must be rebuilt, and governments are signing multi-year procurement contracts to refill and expand capacity. Those agreements schedule larger batch orders and fund production line upgrades, mapping revenue for suppliers over several fiscal years. Long lead items, sensors, precision munitions, secure radios, get placed well in advance so delivery calendars and upgrade cycles stack into predictable backlogs. The U.S. angle adds scale and direction through priorities rather than a single headline number. AI-enabled command and control, hypersonic systems, and integrated air and missile defense. These are not one-off purchases. They require networks, software updates, redundancy, and training cycles that extend the revenue tail. You see programs move from prototyping into production with follow-on sustainment, which simplifies the story for investors. Government contracts create income streams that last for years. Put the pieces together and you get a super cycle defined by mandates meeting modernization. When governments formalize targets and publish procurement roadmaps, contractors build backlog that turns into multi-year deliveries. The cash flow depends less on headlines and more on signed contracts and funded capacity coming online. That's why the theme persists even when attention shifts elsewhere. SHLD aligns with companies operating at the intersection of mandates and technology. Software fused with sensors, autonomy layered on platforms, and resilient networks tying it all together. Budgets become orders, orders become backlog, and backlog becomes revenue you can model with fewer guesswork variables. If policy is the fuel and modernization is the thrust, the next question is which names are positioned to capture the most of that acceleration. So the portfolio leans into concentration by design. 42 names with 62% in the top 10. That's not casual diversification. It's a conviction structure aimed at the parts of the budget expanding fastest. You're not paying for every legacy platform. You're paying for the intersection of policy mandates and the tech stack governments are prioritizing now. Concentration does raise the temperature. Swings cut both ways when an index leans into a handful of leaders. But when budgets point at specific capabilities, air defense, secure networks, autonomous systems, AI-enabled analysis, the case for focus gets stronger. You want companies positioned where procurement dollars land first and repeat over time. The upside of that precision is simple. When mandates turn into orders, The most exposed names tend to move first and most. Think in clusters rather than a ticker roll call. On the software and data side, Palantir creates software that helps commanders make sense of massive amounts of data quickly, turning disparate feeds into decisions. In sensors and air defense, RTX anchors radar, interceptors, and the architecture that stitches situational awareness together. For ammunition and armored capacity, Rheinmetall is central as Europe rebuilds inventories and ramps manufacturing. Across aerospace and precision systems, Lockheed drives missiles and aircraft programs tied to long-running procurement, while BAE adds electronic warfare and mission systems that harden and spoof. Northrop layers in space and advanced systems that support satellite and missile warning networks. These firms sit where software meets sensors, autonomy meets platforms, and secure networks carry the load. That matters because procurement today is less about standalone hardware and more about fused systems. Sensors feeding AI, AI guiding shooters, and shooters cycling back into the network. When ministries fund integrated air and missile defense or AI-enabled command and control, spend flows to this junction. Quality helps the concentration work. The portfolio skews large and profitable with a weighted average market cap around $85.3 billion and return on equity near 18.4%. In plain terms, these are established, cash-generating contractors with substantial backlogs and barriers to entry, not speculative startups hoping for a first award. That base gives Focus a sturdier foundation. You also get global reach. The fund is majority U.S., with meaningful exposure to key allies like the UK, Germany, South Korea, and France. That international mix taps multiple budget cycles and procurement calendars as allied spending converges on similar modernization goals. The mini payoff is that focus plus quality can magnify the supercycle, but it also magnifies what can go wrong. A concentrated book tied to a specific theme will feel shocks faster, policy shifts, détente, program delays, export controls, currency moves across regions. Before you size a position, understand how volatile this exposure can be and what you're paying for access. Let's get precise about the edges: volatility, cost, and the specific risk that comes with a focused theme. Know the edges: volatility, cost, and what could go wrong. SHLD's standard deviation sits around 15.4%, and the expense ratio is 0.5%. You're trading higher movement than broad market funds for specialized exposure, and you're paying an active fee-like cost for a targeted basket. It's also a non-diversified fund concentrated in defense technology, so outcomes lean more on this one sector than a broad index would. Start with the three big risks. First, higher volatility than a core index. Defense tech can swing on headlines, rate moves, and program news. Second, concentration. With 62% in the top 10, a stumble in a heavyweight, Palantir, RTX, Rheinmetall, can move the whole fund. Third, currency exposure from international holdings. A stronger dollar can reduce returns from euro or won holdings when translated back. A weaker dollar can boost them. Keep the scenarios simple and monitorable. Policy and budgets. If defense outlays are delayed or reallocated through a budget renegotiation or an election reroute, deliveries can slip and sentiment can fade. Geopolitical temperature. If tensions unexpectedly cool, urgency for replenishment may ease, pushing timelines out. These aren't reasons to avoid the theme, they're the right checkpoints to watch. International reach adds a second layer. You get access to European and Asian programs that pure US funds miss, but that also brings currency noise and local policy shifts. A cabinet change in a key ally or new export rules can affect orders even when companies execute well. Expect tracking differences versus broad benchmarks. Thematic ETFs don't own the sectors that often lead during sharp rotations. If yields rise quickly, multiples can compress even for backlog-rich names. In risk-off phases, correlations can jump and drag everything lower. That's normal behavior for a focused ETF. Mitigation is about structure. Size the position so volatility doesn't force decisions. Stagger entries to reduce timing luck. Pair with core index holdings so factor swings don't dominate your portfolio. Set a simple review cadence keyed to real signals, budget votes, procurement updates, and company guidance so decisions aren't headline-driven. Keep expectations grounded with a straightforward lens on drivers. Strong dollar periods can weigh on non-USD holdings. Weak dollar phases can lift them. Europe's pace is a swing factor. Faster replenishment supports ammo, sensors, and air defense demand. Slower timelines stretch revenue recognition. You don't need a model, just a mental map of how these forces could nudge returns. There's also opportunity cost. AI or crypto may sprint while defense compounds more steadily. Different tools serve different roles. This one exists to capture policy-mandated modernization, not to beat every hot trade. If that role fits what you're building, the next move is turning interest into a simple, repeatable process you can run quickly and revisit on a schedule. Let's pivot from theory to action. From hype chasing to policy-mandated plays, your next step. You don't need a 40-page report to move from curiosity to a plan. Give yourself 20 minutes and run a simple checklist that keeps you focused on what matters for SHLD. The goal is to confirm the setup, stress test the drivers, and decide how it fits your portfolio without getting pulled into headlines. Start with the source documents. Open the prospectus and the current holdings page on the fund site. Verify the concentration in the top positions, the total number of holdings, and the country weights so you know how much exposure sits outside the U.S. Specifically, confirm that Palantir, RTX, Rheinmetall, Lockheed, and BAE are still among the top holdings and that the 62% top 10 concentration hasn't shifted meaningfully. Scan the rebalancing rules, caps, and any sector or regional limits. Note the rebalance cadence and how additions or deletions are handled. That tells you how quickly the fund adapts as programs scale or stall. Next, line up the catalysts. Check where NATO members stand on the 2% threshold and which countries have published timelines to reach it. NATO's website maintains member updates and targets. For the EU, look at European Commission and European Defense Agency releases covering defense investment, frameworks, and timelines. For the US, use DoD budget justifications and service branch program briefs to track modernization programs tied to top holdings. You're building a live map of policy drivers that can translate into orders. Now review the contract pipeline in a way that's simple to track. Pull the last couple of earnings updates or investor presentations for the top names and focus on 3 items: new contract announcements or awards, backlog growth and funded order intake, and revenue growth from defense segments. If available, note comments on AI and autonomy rollouts, software deployment milestones, and production ramp updates. Backlog plus capacity signals revenue visibility. Segment growth shows it's converting. Run a quick risk sanity check. Ask what would have to change politically for the thesis to weaken. Would a shift in coalition governments delay replenishment? Could export controls cap international demand? Would a budget negotiation push awards into the next fiscal year? Write down 2 or 3 conditions that would force you to revisit the position so your future actions aren't emotional. Decide where it fits. Treat SHLD as a satellite and pick a target weight that won't distort your core allocation. Use dollar cost averaging or scheduled buys to smooth entries, given the fund's volatility. Set review triggers now, budget votes on key programs, major guidance updates from top holdings, and noted policy milestones from NATO or the EU. If those triggers hit, you check the thesis. If not, you stay on your schedule. Close with costs and taxes. Note the 0.5% expense ratios drag at your intended holding period. Check the fund's distribution history so you're ready for payouts, and choose the account type that fits your tax situation. Concentration magnifies both conviction and noise, so pairing it with broad index exposure can keep factor swings in check. This same system, source docs, catalyst, pipeline, risk, fit, and frictions, works beyond SHLD. Anytime growth is driven by policy and contracts. Now, keep that lens in mind as we look at how steady growth often shows up long before it gets loud. That brings us to the takeaway you can act on now. Some of the best growth doesn't shout. It's written into policies, translated into multi-year contracts, and logged as backlog by companies built to deliver. That's a different engine than sentiment-driven rallies and can offer more predictable compounding when procurement follows a set schedule. If you're tired of chasing trends, run the 20-minute checklist on SHLD today. Compare it against your AI and crypto exposure. Then decide what role policy-mandated growth should play alongside your core holdings. Want more? Comment if you want a Palantir versus Rheinmetall deep dive inside SHLD, and I'll show you which is most levered to the 2025 to 2027 spend ramp.